Hello, friends. Today, I am giving you the key to wealth by discussing the investment strategies of a great name, Warren Buffett. People often seek advice from Buffett, one of the world's richest individuals, eager to learn the secrets of his 70-year investment journey. So, where can we delve into the topic of investment? While we compare investment to a light, we consider saving as a shadow. If you cannot make saving a habit, I'm sorry to say that this video you're watching will be a waste of time for you. However, if you can save or are willing to learn, then wait, because this video is just for you. I am aware that topics like savings and accumulation may seem unappealing. However, in the world, especially in countries with inflation, the cash in your bank account or wallet is eroding every second. I know you might be asking, how can we save in an inflationary country? Well, that is not an excuse. You surely see people around you who can earn $1,000 and save, while others earning $10,000 cannot save. If you lack the awareness of saving, no matter how much you earn, you will never become wealthy. When you examine lottery winners, you will see that most of them revert to their previous state. It is because they did not develop a habit that would enable them to stay rich. This is the most important aspect for Buffett. One of Buffett's strategies is to avoid holding cash unless necessary. So, where should we start investing? What journey does Buffett want us to embark on? Step 1, you will set aside 10% of your income. You can put this money in a place where you cannot easily access it. If 10% seems too much for you, follow the logic of growing savings. Put aside $20 in the first week, $40 in the second week, $60 in the third week, and $80 in the fourth week. This may vary depending on your country's currency. If you want to taste financial freedom one day, you need to set aside an average of $100 per month. Adjust the amount according to your income level. Step 2, be patient. Patience is your most important investment on this journey. The biggest problem for people who set out with ambitious goals is impatience. Stop saying things like it's too late for investment. Make your investments consistently every month. When you achieve consistency, you will see that your savings gradually grow. Step 3, focus on two things. The first is the real value of the company. The second is whether the stock price of the company aligns with this value. This is where the concept of value investing comes into play. By studying the market, you can find undervalued stocks. It is possible to catch stocks where the company's value exceeds the stock selling price. In value investing, it is quite high to get $0.25 when you invest $1. Of course, it is not a correct approach to see the stock market as a guarantee. The lack of guarantees also allows you to achieve high profits. Some see the stock market as part of a capitalist system. However, the stock market is one of the great opportunities offered to the middle-income group. Mark, Elon, or Jeff won't come to you and say, "Come, become a partner in our company." The stock market, on the other hand, offers you this opportunity. The most important advice I can give you is not to buy stocks, but to buy company ownership. Don't trust people in groups who say, "This will increase, that will decrease." Research everything about the company you plan to become a partner in. Remember that investing in growing but not yet matured small companies is the most powerful strategy. Once you decide on value investing, first determine your area of competence. Focus on companies in the field where you have expertise. Look for answers to questions like, what do I enjoy doing? What am I good at? What do I spend money on? This way, you will be able to find the types of businesses that suit you. Step 4, don't just invest in undervalued companies. Create your own investment strategy. Buffett can teach you not to lose money, but you should not only rely on what he teaches. Buffett always has a margin of safety against potential losses. He describes this as a moat. Once you are on this path, be sure that there will be significant fluctuations. Close the doors. Be afraid when others are greedy. Be greedy when others are afraid. Rule number 1 is never to lose money. Rule number 2 is to never forget rule number 1. Now, let's talk about the moat concept. The brands that best fit this concept are the most well-known brands. Coca-Cola, Tesla, or Amazon can be cited as examples. These types of big companies have always had a moat and have resisted all the negatives that have come their way. McDonald's, Nike, and Burger King are also examples in this regard. However, we need to make a separate note for Apple. No matter which country we are in, we all have a weakness for Apple products. The brand perception of Apple products shows that this moat will continue regardless of anything. Embracing moat companies means not looking back. Absolutely do this. Now, let's move on to the technical aspect of value investing. Step 5. To invest like Buffett, you need to understand the language of business. And that involves reading financial statements. At this point, most people give up. But if you want to make smart investments, don't delay learning this skill. We have discovered a company that presents a good investment opportunity. Let's call it John's Bicycle Company. We need to check 3 main financial statements: the balance sheet, the income statement, and the cash flow statement. You can access this information from anywhere. We can understand a company's net worth from the balance sheet. When you add up all the company's assets and subtract all its liabilities, including debts, you arrive at this figure. Focus on the debt-to-equity ratio of the company. Let's assume John's Bicycle Company has $1.3 million in net worth and $500,000 in debt. This translates to a 38% debt-to-equity ratio, which is not a bad result. It is possible to find companies with a debt-to-equity ratio of 100% or worse. After that, we need to look at the net profit on the income statement. The key here is the return on equity. Let's say John's equity was $1 million in 2021. The income statement shows a net profit of $520 million in 2022. This means the return on equity is 52%. Anything above 15% is considered very good. Finally, if we want to examine the cash flow statement, it shows how the company utilizes its funds. Is it paying off its debts? Does it have cash for day-to-day operations? Are shareholders receiving dividends? You want to see a consistent positive cash flow, but sometimes large acquisitions can result in negative cash flow. It's not so much about whether it's negative or positive, but how the cash flow has been utilized, whether it has been wasted or invested. In other words, the cash flow history is important. Most people probably haven't made it this far in the video. They likely abandoned it in the 4th step. The reason is that people find technical analysis too complicated. But you can't succeed without putting in the effort. Even if you understand the company's financial situation, you may not always know when to invest. This is where Buffett's investment strategy comes into play: patience. Imagine earning a 40% return on investment every year. Don't worry, I'll explain the mathematical part of this in another video. Step 6. Buying a $40,000 car for $80,000 wouldn't be a smart investment. Buying stocks when their prices are low and about to rise is what makes people happy. The key was developed by Benjamin Graham, Buffett's teacher. The foundation of this method is comparing 2 values, a company's net current asset value and the net current asset value per share. Let's look at John's Bicycle Company. The balance sheet shows the company's current assets are $70,000 and its liabilities are $65,000. This means John's company has a current asset value of $5,000. Now, all you have to do is calculate the net current asset value per share. John's company has 2,000 outstanding shares. If we divide the current asset value of $5,000 by 2,000, we find that John's per share net current asset value is $2.50. What is the current price per share of John's Bicycle Company? If the stock is currently trading below $2.50, then it is undervalued. This represents a potential investment opportunity. Graham believed that the best opportunities came with a 33% margin of safety. If John's Bicycle Company stock is selling for approximately $1.60 per share, we can say it's a good opportunity. Did the math give your brain a workout? Let's move on to something simpler. Step 7. Don't be afraid to make mistakes by investing in just one stock. Diversify your portfolio to minimize the margin of error. When there's a 50% loss, you need a 100% gain to get back to where you started. You need nerves of steel, like steel itself. Be willing to wait when necessary. Even the world's largest companies can experience significant drops from time to time. During those moments, everyone tends to sell. If you have followed the steps here, you will learn to wait and not be misled by negative values. These 7 steps won't make you rich overnight, but they will contribute greatly to getting started. If we simplify the 7 steps, there are 2 key ones: patience and savings. As long as you manage these 2, you will be on the winning side. Thank you for watching this video. Today, we shared many important insights into Warren Buffett's investment strategies, and I hope it has been beneficial for you. Working on the subject of investment and improving oneself can take time. The important thing is to enjoy the process and progress step by step. If you enjoyed the video, please don't forget to like and subscribe to my channel. This way, you won't miss out on my new videos. See you in the next video.